Hello everyone, welcome back. Today we discuss the behavior of interest rates, which is our chapter 5 from our Mishkin textbook. The motivation behind the chapter is that interest rates play a huge role in your monetary policy. Now, what is monetary policy? Monetary policy is primarily the setting of some benchmark interest rate in your economy by the central bank, which will then either stimulate your business cycle or dampen the business cycle, depending upon which way you want your business cycle to move. Now, do not forget that monetary policy is very different from fiscal policy. So what is fiscal policy? If you recall from your principles of macro, fiscal policy is when your treasury benches now want to provide a stimulus or dampen the business cycle. Stimulus could be provided in terms of cutting of taxes, increasing your government spending, or through various different transfer programs that the government gives to businesses or public at large. Now, to put things into perspective, we saw central bankers playing a huge role during global pandemic crisis. We saw US Federal Reserve cutting its benchmark interest rate, the discount rate, to almost close to zero, to be precise to 0.25%. This was followed by the Bank of Canada in Canada over here, also slashing its overnight interest rate to 0.25%. Central bank movements were then followed by stimulus packages provided by the governments of the two countries. Now, this is just an example from USA and Canada. However, we did see similar movements across the globe undertaken by central bankers and also by various governments out there. So in order to see how the interest rates are determined and what factors influence their behavior, recall that we established a relationship between interest rates and bond prices. In chapter 4, we saw that whenever bond prices go up, interest rates move in the opposite direction. If we analyze what causes these bond prices to fluctuate, we can therefore also establish a link that what are the factors that influence the interest rate movements. So we will be using the basic principles of microanalysis of a market for bonds in order to see what causes this fluctuation in bond prices. So let's get started. We will start our analysis with what we call theory of portfolio choice, which gives us the determinants of asset demand. Now, what is an asset? It could be your stocks, it could be bonds, it could be land, houses, farm equipment, manufacturing machinery. These are all different examples of assets. So remember, it is simply any piece of property that is a store of value. Now, what are the determinants of asset demand? Number one is your wealth. Wealth is the total resources owned by an individual, including all assets. So wealth includes your stocks, bonds, money, all of those different items. Then we have expected return. Expected return is the return expected over the next period on one asset relative to the other asset. So do note the term that we will typically be working with relative expected return and not just the standard return. So it is relative to some alternative asset. Then a major determinant of an asset demand is the risk associated with that asset. Risk is the degree of uncertainty associated with the return. So again, over here, we are always looking at relative risk for an asset. And lastly, the major determinant of asset demand is liquidity. So liquidity, remember, is the ease and speed with which an asset can be converted into cash. And again, we'll be looking at relative liquidity and not just the absolute liquidity of an asset. So when one asset becomes relatively more liquid to an alternative asset, how do you think it will determine asset demand? And we typically see that with higher wealth, holding everything else constant, the demand for the asset, in our case, we're looking at bonds. So we'll see bond demand going up, holding everything else constant, expected return goes up, higher bond demand, relative riskiness of an asset increases, bond demand will go down, and the more liquid an asset is relative to other assets, typically we'll see, holding everything else constant, that bond demand goes up. So these are some determinants of asset demand. Now, in order to draw our supply and demand market diagram, we need to establish a relationship between bond prices and the quantity of bonds demanded. So we typically see that at lower prices, the quantity demanded of bonds is higher. Now, why is that? So for that, recall the basic equation for return. Now, let's assume this is a 1-year bond, and because most yields or interest rates on bonds move in the same direction, we can just work with a 1-year bond. So you're getting your face value after 1 year. And let's assume your purchase price today is PT. So your return on a 1-year bond is simply your face value minus price as a percentage of purchase price. And let's assume there are no coupons just to keep our overall analysis pretty straightforward. Now notice that lower the price, today, lower the purchase price, bigger is your capital gain, and therefore higher is your return on the bond. So bond demand will be therefore higher. And we can apply this to all type of bonds, whether they're maturing in a year, 2 years, or 3 years, because remember, we are holding everything else constant except for the purchase price today. So lower the price, higher is the bond demand. So that will give you a downward sloping bond demand curve. And remember, we have price on the y-axis and quantity of bonds. A lot of students later on, as we do various different models throughout the course, will confuse this bond price as your price level in the economy. This is not your price level in the aggregate economy. This is simply the price of bonds, and we have quantity of bonds on the x-axis, and we have an inverse relationship between the two. Bond supply is determined by your relationship between price of a bond and the quantity supplied of bonds. Remember, supply of bonds is coming from your sellers of bonds, the borrowers, people who want to raise external funds, and bond demand is coming from your investors, people who want to put their savings away in the form of an asset, in this case bonds. In this case, you see that lower the price of the bond, higher is the yield. And remember, yield or the nominal interest rate is a cost of borrowing for the borrower. So higher the cost of borrowing, the less they are willing to issue new securities, and therefore bond supply actually falls. So because this is increasing their cost of borrowing. So we see a positive relationship in this case. Lower prices, lower bond supply. And therefore the quantity supplied of bonds increases as price increases, and quantity supplied of bonds decreases as price decreases. So in this case, we have a positive relationship. So I have the two diagrams together. Remember, it's the price of bonds on the y-axis, and we have quantity of bonds. In this case, your equilibrium price of bonds is $5. Now remember, for any given price over here, there is an internal interest rate or the internal yield that we calculated in chapter 4. So at 5, we can assume for now that the internal yield is, let's say, 4%. So this is corresponding to some interest rate, I star, nominal interest rate of 4%. As we work with higher bond prices, the internal yield will be going down. So higher the price, remember, the yield to maturity decreases. So instead of 4, let's assume a bond price of 8, the internal yield, we can assume it to be somewhere close to 2%. And I'm just working with hypothetical numbers over here. And if we are working with lower bond prices, so let's assume we go down to price of bond of 2, now we'll be working with some higher yield, and let's assume that yield to be 6%. So lower the bond price, higher is the yield. Higher the bond price, lower is the yield. So whenever you look at this diagram, you'll always draw it against the price. The quantity of bond demanded and bond supplied is drawn against the price of bonds. However, remember, whenever prices are moving in a particular direction, your internal rate of return or the yield or simply your interest rate is moving in the opposite direction. Let's look at some shifts for demand for bonds. Now, what causes fluctuation in interest rates holding everything else constant? Wealth effect is pretty simple. Remember, we just discussed that higher the wealth, higher is the demand for any given asset. That was coming from our theory of portfolio choice. So if I was to draw my bond demand and supply framework, I'm working with higher wealth. This could be in terms of a business cycle boom. So overall economy is doing well. We can show this as a shift in your demand curve. So your demand curve shifts to the right. And as you can see, we'll be working with now a new higher price, in this case approximately $7. Price of bond is now higher at the new equilibrium, and therefore the interest rates are going down. So if I was to look just on the demand side, a business cycle boom or expansion because of the wealth effect is causing your interest rates to go down. Expected returns. Next we'll see what is the effect of different type of expected return on the demand for bonds. So there are 3 main factors that can influence your expected return, and we'll go over them one by one. The first one is your expectation about future interest rates. So when you expect future interest rates to be going down, and we did this in chapter 4. So let's see how will this affect your bond demand today. So if you're expecting lower interest rates in the future, you know that the future price of bonds is going to go up. As your future price goes up, holding your current price constant, what happens to your return? Now this is constant, and this is expected to go up, and that causes your return on bond or expected return on bonds to go up, and therefore demand for bonds today will go up. And in your demand supply framework, bond demand goes up, causing your price of bonds to go up and therefore causing yield to go down. So if we expect future interest rates to be going down, bond demand today will rise, causing current yield to also go down. The second effect that we wanted to see on expected return comes from expected inflation. So let's assume expected inflation decreases. And remember, you are now thinking of the bond demand, which is people buying these bonds as a saving instrument. Expected inflation, therefore, is giving them the return on an alternative asset. Specifically, it indicates the return on some real asset. So rather than putting your wealth in the form of bonds, if you were to put it in terms of a real property like a house or a piece of land. Now, if you're expecting inflation to go down, you're expecting the property price to go down, and therefore your relative expected return on bonds, so let's write relative return, and I'll put a little e over here. Relative expected return on bonds is now actually going up because relative to your real asset, return on bonds is now relatively higher. Remember, as when I was describing the determinants of demand for an asset, we said we will always look at these determinants in terms of their relativity. So as bond return is now higher, this causes bond demand to increase today. The bond demand curve will shift to the right again, pushing the price up. And as price goes up, yield on the bond is going down. So if we were to focus just on the demand side, expected inflation going down causes yield to go down. Expected inflation going up will cause your yield to go up. This is just one side of the story. We still have to do bond supply, so wait for that. For the last one, let's assume it's now return on your stocks that is going down. This could be because stock market is crashing, etc. So people are not preferring to hold stocks. Bonds are therefore becoming relatively more stable and relative return on bonds is going up. This again causes bond demand to increase to the right and bond supply in the same, and again it pushes the bond price up today and lowers the yield on the bond. Cost of borrowing on bonds has actually gone down. These are all different ways that expected returns can be affected, and expected return on a bond will always be a shifter of your bond demand curve. The third one was risk. Risk is also pretty straightforward. If an asset becomes relatively more riskier, so the more riskier an asset, bond demand will now go down. So instead of bond demand curve shifting to the right, holding everything else constant, shifts to the left, and with bond price going down, yield is actually a lot higher. So whenever an asset become, or in our case, bonds become riskier, yield always increase with that. You must have also observed this intuitively, that riskier an asset is, higher is the interest rate demanded by the investor in order to compensate him or her for taking on that risk. Let's look at liquidity, which was our fourth determinant. So if bonds become more liquid, so they have a bigger secondary market, they are easily traded they can be easily liquidated whenever you want them to, we'll see that again bond demand will become higher. Shifts to the right, bond supply is the same. So as your bonds become more liquid, bond demand has increased and causing your price of bonds to go up. And as bond prices go up, yield on the bond is going down. So always that inverse relationship from our present value calculations in our previous pricing of various debt instruments. So remember, all of these determinants of asset demand are taken in relative terms. So if the liquidity of another asset goes down, for example, your brokerage commissions on stocks are going up. So stocks are becoming now relatively less liquid because there's an additional transaction cost of doing that. So as stocks become less liquid because of higher brokerage commissions, we will see that relative liquidity of bonds is now higher. And with higher relative liquidity, we'll see the same effect. Bond demand increases, causes the price of bonds to go up, causes the current yield to therefore go down. Remember, supply of bonds is coming from the people who are borrowing money. So they are issuing securities in order to get external financing. So these are your borrowers of the economy. They will always borrow more when price of bonds are higher, because higher price is associated with lower yield, lower cost of borrowing, and quantity supplied of bonds is therefore higher. So we have an upward sloping supply curve, downward sloping demand curve for bonds. But now we want to focus on what causes the shifts in our supply curve. So let's start with the first one, expected profitability. Whenever firms expect higher profits, this could be in terms of, business cycle expansion. If their expected profitability goes up, do you think they'll be willing to borrow more funds or borrow less funds? I think that in a situation like this, they would be willing to borrow more funds, and therefore they're willing to issue more liabilities, and bond supply will increase. Could be many various reasons which are causing the expected profitability to go up. I've used business cycle expansion as one possible effect, expected higher growth of the economy, of particular sector of the economy. So firms in that sector will be now willing to issue more liabilities, borrow more funds today in order to invest in further expansion opportunities, and bond supply increases. Note that price of bonds is going down, and therefore yields are going up. And you can always do vice versa. Whenever businesses expect lower profitability, they will reduce their borrowing. So bond supply will decrease, push the price up, and yields will actually go down. Next, we have expected inflation. For expected inflation, recall your Fisher equation, and I'll write it down over here. Fisher equation was giving you your inflation adjusted interest rate. So this is your nominal interest rate, which is what we are looking at over here in terms of fluctuation of bond prices. And this is your expected inflation. If expected inflation decreases, your real cost of borrowing will increase. If expected inflation was to increase, so you're expecting higher inflation in the future, in this case, your real interest rate is going down. Your real cost of borrowing is going down. And with reduction in your real cost of borrowing, borrowers are willing to borrow more, and therefore supply of bonds will increase. And it's the same diagram now. With higher supply of bonds, we see price of bonds being pushed down and yields therefore going up. The third one is your government budget deficits or surpluses. So when the government starts borrowing more, this is typically when their government spending is higher than their tax revenue. In order to support this additional expenditure, they will be issuing more bonds. And as they issue more bonds, their treasury bills, will see bond supply again increasing. Same effect, price of bonds is going to go down and yields are going to go up. If the government instead runs a surplus, in this case, you have additional funds lying with you. So your tax receipts are now higher than your government spending, and therefore government can pay off some of its debt, and overall supply of bonds will actually decrease. And as it decreases, the supply curve will shift to the left, and we see higher bond prices and lower cost of borrowing. Yield will actually go down. So this was your supply shifters and 4 main determinants or factors affecting your bond demand. Now let's put them together in a couple of applications. So this is an application looking at what happens to your bond prices and therefore yields when inflation is expected to go up. Now, whenever you see a situation like this, remember expected inflation affects both your borrowers and your lenders. So let's look at our borrowers first. If expected inflation is going up, your real cost of borrowing actually goes down. And as your real cost of borrowing is going down, you are willing to borrow more. So you're willing to issue more liabilities. So supply of bonds will actually increase. On the side of my lenders, which are my party representing the demand curve for bonds, we have demand for bonds. And recall expected inflation going up is telling us that the return on your real asset is going up. And as you're now getting a higher return on your real assets, relative return on bonds is going down. And with lower relative expected return on bonds, bond demand will actually go down. And the bond demand curve shifts to the left, and you have a lower price level. If this was your original price P1, you have a new lower price in your bond market. So both the supply and demand curves are moving in a way that there is no ambiguity, and because of higher expected inflation, my overall result is that price of bonds are going down and causing your yields to go up. Remember, when there is a factor which influences both parties, you must be identifying how it affects each of the these parties, in which direction will the supply or the demand curve move, and therefore what will be the overall effect on your price of bonds and interest rates in our economy. Now let's see if this result is consistent with our Fisher equation. Your Fisher equation immediately tells you the movement in your nominal interest rates whenever inflation is expected to go up or down. So just focus on this Fisher equation over here, and your Fisher equation immediately tells you higher the expected inflation, higher will be your nominal interest rate. So your bond demand and supply analysis is giving you the exact same result, higher expected inflation causing price of bonds to go down, and again giving you nominal interest rates as being higher. Let's look at data. Does data support our results? So we have data over here from 1953 to 2017. As you can see, whenever you see higher expected inflation, nominal interest rates also tend to go up. This is for 3-month treasury bills, which are quite responsive to inflationary expectations. And whenever we see inflationary expectations being dampened, nominal interest rates tend to move with them, and they are also going down overall. A very strong policy implication over here is that if we somehow control our expectations of inflation that the public is forming, we can end up controlling our volatility in interest rate movements also. And we'll see a lot of this when we talk about monetary policy in detail in our last few chapters for this course. Let's do another application now for business cycle movements. And I have the example of a business cycle recession over here. So your GDP is going down. You can also work with the same way with expectations of GDP going down. So it's expectations of a major recession or a contraction in our economy. So we'll start with our initial diagram. So bond supply, bond demand, and we can label it as BD1, BS1, some initial price of bonds. And when we have a recession in the economy, remember this effect is again going to affect both your borrowers and lenders of our economy. So both the demand side and the supply side. On the demand side, this is the negative income effect or wealth effect. So people are not willing to hold as much of any given asset. So we see bond demand actually going down. With lower bond demand, we have price of bond going down. With lower price of bonds, we have the internal rate of return or the nominal interest rate going up. Remember, they always move in opposite direction. On the supply side, which is your borrowers, bond supply will be affected in the opposite way. Recession in the economy, borrowers are not willing to borrow more, so supply of bonds will go down. They expect lower profitability in the future, and therefore supply of bonds has decreased. And as bond supply decreases, this actually causes price of bonds to go up. Now this is a pretty interesting outcome because both effects are moving our bond price and therefore yield in opposite direction. If we observe our data from past, we typically see that it's the supply side effect which is the dominant effect. Not in all recessions or expansions, but most of the time we see it's the supply effect which is the dominant one, and on the demand side it's a much smaller impact. So I can actually move my supply curve a bit and make it a much bigger effect to show the bigger impact on the supply side. So I'm just shifting my bond supply curve to the left quite significantly to show that this is my dominant effect. Price of bonds is overall going up, and as price of bond goes up, yields are going down. So we typically see that in a recession, interest rates are going down, and likewise for an expansion, interest rates will be going up. So this analysis over here shows us that interest rates are pro-cyclical. Whenever a variable moves with the business cycle, we call it a pro-cyclical variable. So in this case, your business cycle recession is causing your interest rates to go down, or business cycle expansion will cause bond demand to increase, bond supply to increase, pushing if the supply effect is again dominant, it will end up pushing your interest rates up. So interest rates are pro-cyclical according to our bond demand supply analysis. So let's look at our data. Over here, I have my data from 1962 to 2017, and this is for 3-month treasury bill yields. Gray bars are showing you major recessions in Canada. So we had a major recession in 1970, mid 1970s, another in the early 81, 82, the 91 recession, and then the big financial dip in 2009. So you can see that in most of these recessions, interest rates are going down. And this is again consistent with our analysis of the bond demand supply framework, that whenever we have a recession, or most of the time in recessions, interest rates tend to go down. And when the economy is in a recovery mode and it's moving towards its peak, interest rates tend to follow the same route. So when business cycle is expanding, interest rates tend to be going up. So the pro-cyclicality of interest rates is quite easily shown through our bond supply demand framework. Right now, we see that the 10-year yields have been plunging down during the COVID pandemic. And this is again consistent with our framework that we just discussed. The COVID-19 pandemic is a huge recession. So your GDP is dipping down significantly. And again, you can see your bond supply is therefore going down. Bond demand is going down. This is your dominant effect, pushing your price up and therefore pushing your yields down. So that's all for today. We are a pretty simple framework of bond demand and supply analysis. It helps us explain how the overall level of nominal interest rates are determined, and it also very nicely explained the fluctuation in our nominal interest rates that are often observed in our economy. So I hope you enjoyed this video. I'll see you guys next time when we look at the risk structure of interest rates. Thank you for watching. I'll see you guys next time.